Welcome to this week's client support webinar. My name is Bennett McDowell with traderscoach.com, and today is December 11th, 2024. Happy holidays as we head into the holiday season. All right, so let me just go through my administrational items. Any questions that you have, feel free to type those in at this time. As you know, the recordings are going to be kept on our YouTube channel, but in a secret area, a private area. The reason we do that is because we kind of want to keep these kind of just amongst us and our clients. So anything that you may ask, if it's personal, somewhat personal, it won't be all over the internet, right? So I think that's important. Okay, today we're going to talk a little bit about scaling in and out of trades and some of the advantages and disadvantages of doing that. So I do want to cover that and how you can use the ART signals to do that as well. All right, let me go through some of these administrational items. Just a quick note, we do stock analysis Friday on Fridays. So, if you want to come in and have me look up a stock for you guys, feel free to join us then. And that's every Friday. We're not going to be doing it this week. We're skipping this Friday, but we'll pick it up next week, okay? So starting the following week, we'll be there for stock analysis Friday. We usually do it every week, so it's kind of fun. It's a good way to find some stock picks too. All right, let's see what else I can cover here. We have a tutorial, an in-person tutorial here in Arizona coming up in February. A lot of demand on that. It's going to become first serve, of course, and I think we've got about 8 spots open. So we'd love to see anybody there. It's a small group. We try not to keep it. We haven't officially announced it yet, but you'll be getting an email soon and it'll fill up pretty quick. They usually do. Gotten a lot of interest for it. Basically, it's going to be 2 days and we're going to actually be trading the markets. We're going to be meeting on a Sunday and a Monday. And on Sunday, we're going to start about 3 p.m. and go to about 8 p.m. And we're going to trade the Asian market because that opens up on Sunday. So we'll trade that around 6 o'clock. Cover some theory on Sunday, trade a little bit, get you ready for Monday where we'll trade all day. And we're going to be trading very short time frames. We'll probably trade the NASDAQ as well. So we'll be doing a lot of that. And a lot of the trading that we do on a day trading basis can be applied to any time frame in any market. So it's a great way to learn quickly how to mix and match the ART signals in order to be profitable. All right, let me go through the administrative items for today and get those out of the way. And the first thing, of course, is our risk disclaimer that we have to do for webinars. And we just want you to be aware that there are risks in the markets. Everything is a realm of probabilities in the markets. There's no guarantees in anything we do. So we work in a realm of uncertainty at times. And that's why you have to use risk control on each and every trade and also trade with risk capital. And if we come across any stocks or any methods here that you like, please run those by your financial advisor to be sure they're suitable for you. I don't know your personal situation, so they can help you make that final determination. What else can I tell you? In terms of the risk situation, if you want a day trade, I strongly suggest using a prop account so you're not trading your real money until you get really good at this. It takes a while. Day trading especially will be the hardest easy money you'll ever make, so to speak, because you have to have an edge. If you don't have an edge, you're just going to dwindle your account down. And one of the things I like about the prop firms is that you're basically trading their money, and also too, you can open up many, many different accounts. For example, you can have 20 Apex accounts from a variety of different ranges, anywhere from like 25,000, I think, up to 300,000. And you pay a monthly fee for that. And then they start you out on an evaluation account. And once you get good at that and meet their parameters to get funded, then you actually get a funded account. And then you trade, or basically trading on that funded account. And if you lose the money in that funded account, that's not money out of your pocket, okay? Because it is their funded account. And so you do get a 90% payout on any of your wins in that. So I know people making hundreds of thousands of dollars every few months. I know some that are making over $100,000 a month. Yes, that's right. Over $1 million a year trading prop accounts. So it is possible, but you do have to have an edge. I'm going to put a link up in the chat area if this interests you, where you can actually go there and get a savings on their subscription fees for their evaluation accounts. And don't forget, with each evaluation account, you also get free intraday futures data. So you don't have to pay for data with that. So it's a pretty good deal, I think. I recommend it for anybody wanting to get involved in that. All right, my new book, The Art of Trading on the Far Right, is done out. This, I think they're saying maybe at the end of this year. I think officially it was January 9th, but I think they're actually shipping in December now. So I'm pretty excited about that. It's 608 pages. I think personally it's the best book I've ever written. I put a lot into it, and I tried to cover everything that's important, and all the modern stuff of today as well is in that book. I also have books on money management, Elliott Wave, and so forth, so you can check those out as well. And you can get those at our Amazon page. Now, most of you here, I can tell because I can see the list of people here, most of you guys have the ART software already, but you know, you can also add on other software tools as needed. You can do the OWL, the PTF, TLM, ERI indicators. And we use those to confirm the signals on the ART software. So that's kind of a cool thing. And then we have scanners and risk control software as well. So that's all available too. All right, well, let me come out of here real quick. And I'm gonna just go ahead and go to my NinjaTrader charting platform with the ART software in there. So I wanted to talk about scaling in and out of trades today. We've gotten a lot of questions on this on some of our other webinars that we did. So I thought it'd be a good thing to cover. So I just want to bring up the whiteboard for a minute and go over a couple things. So let's just call this scaling. All right, we'll just title the whole umbrella here called scaling. All right, now there's different types of scaling. So you can actually scale into a trade. So let's put into, and you can scale out of a trade. So let's put out over here. So when we talk about scaling into a trade, basically what you're doing, if you have an existing trade, it doesn't matter if it's long or short. Let's just say it's a long trade for right now. But basically you're adding on to your position. So if you trade, for example, you know, a futures contract and you got 10 contracts and you want to scale into that trade and add 5 for a total of 15, well, you can do that. And you can do it at any time the trade is open. Likewise, if it's a stock trade and let's say you went in with 500 shares and now you want to add another 500 shares, well, you can do that just like you did with the futures example. You can just click the buy button and add on to it. So why would you want to do that? Anybody? Why would you want to scale into a trade? Let's see what everybody says here. Okay, the dollar cost average. Okay, we're going to talk about that. Anybody else? Increase profits in a winning trade. Okay. All right. Well, yeah, both those are good, and some other things are coming in here too. Okay, so that's a really good point. All right, so there's 2 reasons to scale in. One is, we'll call it I don't know if you've heard of this term, DCA, which stands obviously for dollar cost averaging. All right, and the other one is just to say adding to profitable trade. I'll just put profit. Okay, now what's the difference? What is the difference between that type of thinking? Correct, okay? So when you dollar cost average, usually when you talk about that, most people are talking about adding to a losing trade, okay? So let's say you bought a stock at $10, all right, and it's down to $5, and let's say you bought, you know, 1,000 shares at $10 and another 1,000 shares when it went down to $5. Well, your average cost is going to be what? $7.50 for 2,000 shares, right? So what's the benefit of doing that? Well, if you still believe the market is going to move, let's say up, let's say it's a bullish trade. Let's say the market's going to move up, and the market gave you an opportunity to buy at a lower price than your original price. Well, that may be something you want to do, right? And that's called dollar cost averaging. And then if the market goes way up where you think it's going to be, now you're going to have 2,000 shares, and you're going to have it at a cheaper price than if you bought the 2,000 at $10. So that's why people do that. All right. What's the downside to dollar cost averaging? What's the downside? Because there is. Okay, increases your risk, correct? What else? Builds bad habit. Okay. All right. That's some truth to that for sure. All right. So when we talk about DCA, the major problem with DCA is that it's increasing the risk on the trade. And you got to be careful when you do the dollar cost averaging to always stay alert to how much you could possibly lose with the additional add-on if the trade gets stopped out. Okay, so that's what you got to worry about with dollar cost averaging. So let's say you're using the trade size calculator and you're carefully calculating the amount of shares you could buy, and let's say it says you can buy 1,000 shares. Okay, so if it tells you could buy 1,000 shares and you buy all 1,000, well, you calculated your risk on 1,000 shares. So if you add into that from that time on, then you're increasing your loss percentage, right? So that's not good. That's not a good thing to do, because if you get stopped out, it's almost going to be like getting stopped out on 2 trades, right? So you kind of don't want to do that. The better way to do that, there's 2 better ways. One is basically if your trade size calculator says the most you can go in and at $10 is 1,000 shares, maybe buy 500. And then if it pulls back to $5, you buy the other 500. And now you have not increased your risk because you got it at a better price, and the stop can even stay where it is. So that's possible. Okay, you can certainly work on that, because a lot of times, for example, a pyramid will get hit and the market will pull back a little bit. So you can experiment with going in with half your trade size when the pyramid gets hit, and then if it pulls back, go in with the other half. Of course, the problem is that if the market just takes off, then you'll never get in with the amount that you originally wanted to. So in the markets, there's always a pro and a con to everything we do. There's no free lunch, so to speak. So you got to kind of play around and see what kind of thing works for you. Maybe when you practice with your trading edge, figure out how many trades go against you right after you add, take an initial position. And, if it's, a trade can go against you and you're not stopped out. That does not mean the trade failed. It just means that you're giving the trade a little room to work, and it's quite normal for it to pull back during the course of its journey up to profitability. So the key is that if that happens to you maybe more than 50% of the time, maybe that's not a bad strategy to go in with half of your position, and then if it pulls back, go in with the other half, and there you have it. Okay. All right, so that's dollar cost averaging, and that's basically adding in to a losing trade. All right, now you can also add into a profitable trade. So for example, let's say you get another pyramid trading point after your initial pyramid trading point, and now you move your stop up under the new pyramid, so that the risk from the first trade is now gone. Now you can add in on the second pyramid, and you can put your stop right under that second pyramid. So if you get stopped out, you lose on the second add-on, but you made money on the first add-on. So the risk is still just like it was the initial risk from the first position. So that's kind of a way I normally teach adding into a trade. Don't add into a loser, kind of add into a trade that's profitable only. Now, with the exception of that is if you want a dollar cost average by adding into half your position on the initial entry and then the other half if you get a pullback, okay? And then you can add on to it again if you get a new pyramid anyway, all right? So that's into adding or scaling into trades. That's adding to your position. What about scaling out on the far right, okay? What are the pros and cons of scaling out? Let me know in the questions area. Taking profits. Okay, fine. Lock in that profit. Yep. Get out before a reversal. Okay. All right, what about the cons of that? Reaching your target with less shares, correct. Okay, so in other words, if you have a target range that you're trying to get to and you scale out before you get to it, well, then if you calculated the profit potential of that trade in the beginning of the trade when you first took it, well, if you scale out before you get to the profit, you're not going to have the same amount of gain as you thought you were going to have. So that is, again, always a pro and always a con. You got to weigh that. So you got to figure out how you want to do that. Now, can you scale out also at a loss? Let's say you go in with 1,000 contracts and it pulls back and you kind of get scared out of some of your half of your position. Could you sell half your position? Sure, you can do anything you want. Just a button push away, right? Sure, you could do that, but try not to, all right? Because if you have not been stopped out, then the reasons for taking the trade should still be there, okay? So in other words, if you have a pyramid trading point or a art reversal entry and have not gotten stopped out, well, don't let the noise of the trade create fear to freak you out and get out of the position, even though it hasn't been stopped out. Okay, a lot of people let that happen. So you want to be careful not to do that. So there's some pros and cons of doing that. What you could also do with scaling out is you could, you know, basically if you start out, you may want to put a sell half your position if it reaches your target. Maybe it's a fib target or a PTF target. And then you can trail the other half up under a support areas, pyramids, okay, P in there, or pyramids or price bars, right? So you could do that. Pardon my, hard to write with this thing. Okay, there it is. Let me erase that, that's pretty bad. All right, so there's lots of different ways you could, you know, trail those stops up under the current one, okay? So you could do it that way. You know, if you reach your target zone, you don't have to take half. You could, at that point, trail your stop altogether up under the price bar. Maybe put half at the pyramid to give it a little bit more room. And then at the closest pyramid, you know, the stop loss level. And then maybe half up under each price bar once it reaches the target zone. So if it reverses, you get out right away with half, but at the same time, you're letting it go as high as it wants to or can in the target zone, all right? So that's definitely a possibility. So scaling out is going to affect your results a great deal depending on how you implement it. And I want to cover that today because I think it's important to realize that. And I think you need to practice with it. You know, you have simulated accounts that you could practice this on. But the main thing with scaling into a trade is you've got to be careful of your risk. All right, because every time you go into a trade, you're increasing the risk. And use your trade size calculator. If your trade size calculator says, hey, you know, you can go in 10 contracts on the NQ on a large account, if your stop is set here, don't go in with more than 10 unless your stop moves up high enough to take out the risk from the original 10, right? Okay, so that's adding basically to the profit, okay, of a trade. And then that's okay to do, because then if it keeps going, now you've got twice the position size without increasing the risk. Because the risk on the first trade will make you a profit, it's gone. All right, provided you put your stop at the second pyramid. All right, that's kind of cool stuff, right? All right, so let's just kind of take a look here. This happens to be, I'll just choose this, I just happen to have it up, GBTC. So for example, let's say we went in on this pyramid. Let me just open this up and make it a little clearer, just kind of give you a real life example. So if you went in on this pyramid here, this first one, not the red one, that's from a trend down, so forget that one. So if you went in on this one, and you went in, you would go in on this price bar over here, and your stop would be under here, right? You got another pyramid entry here, and your stop would move up here. But you can't take a full size trade here because your stop hasn't taken out the profit of the first entry. All right, so you need to have that base leg stop above where you got in order for the risk to be gone on the first trade. So let's say you don't do anything except move your stop up on here. All right, and then you get to this third one and a fourth one. Well, the fourth one happens before the third one, so your stop actually would be here, right? And then this one would show up. So this would be your third one. And you could add into there because of this, your original entry with the original stop. Now the stop is up under here. So you've made a great profit on the first entry. So if you took a trade here and the risk was 2% and you got stopped out, then you would lose on this second entry 2%, but the gain minus 2% of the loss would be your profit on this entire move. So you'd still be profitable, even though you added in to try to make even more money if the trend continued up, right? So that, why would you add in here? Well, because you think it's going up further, and now you can safely add in, and no matter what happens on this trade, as long as your stop is here, you'll make a profit. And at the same time, increase your trade size. So if it goes up much further, you'll make even much more money, okay? So that's kind of a cool thing, right? So that's kind of the deal with that. Now, let's just see if we can find an example here. Well, let's just use this, okay? All right, so, well, no, I don't want to use that. We want to try to find why the pyramids work so good on this. Let me just see if I'm trying to find one where it pulled back before it took off. Okay, here we go. So, all right, well, that's not your first entry, but let's see if we can find something here. Okay, well, let's just go back to our original example right here. So let's just say we went in on this pyramid here, okay? We went in, it went up, and then it pulled down. Now remember, we talked about scaling in and out. So if you went in with your full shares of 1,000, let's just say you went in with 1,000 shares. All right, you did the trade size, and the trade size says you can only use 1,000 shares with a stop under here for a 2% risk, right? So let's say the market moves up and pulls back, and you're like, shoot, I now can buy more at a lower price that I bought my 1,000. So I think I'll buy another 1,000 here, okay? The only problem with that is you're going to increase your risk, because even though you're buying 1,000 cheaper than the first 1,000, now you've got 2,000 at a price that would increase your risk beyond 2%. So that's what you got to be careful about. Now, another way to do this, it would be if you bought let's say you did your trade size calculator, it says you could buy 1,000 shares, but you go in and you bought 500. And you say, well, if I get a pullback, a 50% pullback or a pullback, and then another surge up off that bottom, and I can dollar cost average in for a lower price, I'll add the other 500 on. You're not increasing your risk because your trade size calculator said you could do 1,000. What you're doing here is actually lowering the cost basis of the trade by the additional add-on without increasing the risk, and actually even doing a little bit better on the risk than you did before, because your trade size was only 500. Trade size calculator said you could do 1,000. You're adding on the additional 500 for a total of 1,000, but at a better price on the second 500 add-on. So technically your risk is even going to be less now. All right, so that's something you can play around with. And I can tell you, one of the things I notice is usually, most of the times when I go in a pyramid, they pull back a little bit. So if you're finding that happens to you more than 50 or 60% of the time, then go in with 500, half the trade size, whether it's futures or stocks. Go in with half the trade size, and when you get the pullback, go in with the other half, and no harm done. And in fact, you got a better price. Okay, so keep that in mind. Now, if you add into a winning trade, that's fine, but just make sure your stop on the winning trade cancels out any loss from the first trade, or else you're going to increase your risk, okay? All right, so I think, how's that? Pretty good for everybody? You get a lot of questions on that. So dollar cost averaging, can be pretty good if you do it in a smart way. That's the thing. You just got to be careful not to get too carried away with it, because there are pros and cons to that. Pretty much to everything you do in the market. All right, good enough. You're welcome. Thank you. All right, well, that takes us kind of to the end of the session, which is kind of what I wanted to cover today. And we're going to be back next week. All right, and then after that, we'll skip because that falls on the Christmas Day. So I'll see you all again next week, and I hope everybody's having the start to a good holiday season. We do not have stock analysis Friday on Friday this week. We're going to skip this week. I have some business stuff to take care of, and then we're going to resume again the following week on that. All right, so I will post this in the normal area, in our secret hidden area on YouTube that you have access to through the VIP portal. And you guys have a great week. Thank you so much, everybody. Have a good one. Bye-bye.